Many pre-retirees might not realize it yet, but one of the biggest tax implications that I see hit during the retirement years is that of required minimum distributions. You might have spent years or even decades saving in your pre-tax accounts, letting those investments grow tax-deferred over time, and one day the IRS comes knocking and says it's time to pay up. You have to withdraw certain sums of money whether you want to or not. The catch is, every dollar withdrawn adds to your ordinary income on the year, and this can eventually cascade into causing things like increases in Medicare premiums or higher amounts of Social Security being taxed as well. That's why I feel it's imperative to make this video today, because I'm going to explain exactly what RMDs are, when they may start for you depending on your date of birth, how they could end up piling up and snowballing to very large sums of money over time, and the exact strategies that you can consider to hopefully mitigate these tax implications in the future. Let's start with the basics here, because when it comes to RMDs, I see a lot of half-truths or misconceptions as far as retirees' understanding is concerned. First things first, if you're born between the years of 1951 and 1959, your RMDs are set to begin at age 73. If you were born in 1960 or later, however, those RMDs are going to wait until you reach the age of 75. And this is important to understand because it creates two distinct buckets of retirees when it comes to planning for income in the future. So why does the government require RMDs at all, you might ask? Well, it all goes back to how these traditional retirement accounts are structured. In the case of individual retirement accounts, you might have received a deduction for your contributions over the years, and those accounts ended up growing tax deferred. In the case of an employer-sponsored plan, both you and your employer received a tax deduction for contributions, and those accounts also grew tax deferred until the time when you have to withdraw in retirement. And when that time comes, the bottom line is the IRS wants to collect on some of that growth in the form of taxes. The way the actual calculation works with regards to RMDs can also be important to understand, because first and foremost, it's not just a flat percentage across your lifetime. In addition, it's not optional. Each year, the IRS looks at your previous year pre-tax retirement account balances, and that number is then divided by a lifetime expectancy figure published on their annual tables. Earlier on in retirement, in your early 70s or so, that number might be closer to 25. So your RMD equates to roughly 4% of your year-end balance. But as you age, that divisor declines, and the amount that you have to withdraw on an annual basis could end up increasing quite dramatically. And the bottom line is, if you don't take the money out, you could end up facing stiff penalties of up to 25%.